Imagine finding a forgotten key, one that unlocks some really significant financial benefits for your business. Maybe even gets you a tax refund from years ago.
Right.
Or think about it like a strategic shield, something that protects your future earnings from, the full hit of taxes.
Hmm.
Well, today we're doing a deep dive into two really powerful tools in the tax code that work kind of like that. Net operating losses, NOLs, and the often pretty confusing world of corporate capital loss limitations.
Yeah, they can definitely seem confusing at first glance.
Exactly. So if you've ever felt maybe overwhelmed by just how complex tax planning can get, but you've been hoping for those like aha moments, the ones that could actually make a real difference to your bottom line, well, then this deep dive is definitely for you.
Absolutely.
We're going to try and unpack the, let's say, the tricky bits of these regulations, help you get a quick handle on what's most important, and crucially, how you can actually use these ideas to get some significant tax advantages.
It's true. The tax code, it can feel like this incredibly dense forest.
Right. Totally.
But honestly, with a bit of guidance, what looks like a maze often turns out to be, well, a series of logical rules. Highly specific rules, yes, but logical ones designed to achieve certain economic goals.
Okay.
So our aim today is really to demystify these mechanisms, let you see how they actually work in practice, understand their strategic value, and, ultimately use them to help your company's finances.
Okay, so let's start by really digging into net operating losses, or NOLs.
Uh,
What are we actually talking about here?
well, at its most basic level, an NOL happens when a company's allowable tax deductions for a given year add up to more than its taxable income for that same year.
So basically, a loss for tax purposes. Simple enough.
Simple enough, yeah.
Yeah.
But here's where it gets really interesting, and maybe where that first aha moment kicks in for a lot of people.
Okay.
This isn't just a loss you write off and forget about. It's actually a critical kind of dynamic tax-saving tool.
Right, so it does something.
It does something, exactly. It means that a bad year financially, maybe because of an economic downturn or big startup costs, or even just making some large strategic investments, that loss can actually become a future tax reduction.
Okay, a reduction. That makes sense.
Or, and this is the really compelling part in some cases, it could even lead to getting money back. A tax recovery, a refund from taxes you already paid in previous years.
Wow, okay. So a loss today could mean cash back from yesterday. That feels almost backwards.
It absolutely is counterintuitive for a lot of folks, and that's exactly why getting a handle on NOLs is so powerful.
Uh-huh.
And what's interesting, while we're focusing mainly on corporations today, the basic ideas behind NOLs, they apply broadly to individuals too.
Oh, really? Okay.
Yeah, that consistency across different types of taxpayers, it really highlights the basic policy goal here. It's about providing relief during tough financial times or periods of heavy investment.
Like a buffer.
Exactly.
Mhm.
Think of it as the tax system's way of sort of smoothing out the bumps, the peaks and valleys
Yeah.
that businesses inevitably go through. It lets you use losses to offset income over a longer period, recognizing that profit isn't always a straight line up.
Right, right. And speaking of peaks and valleys, the rules for NOLs themselves, they haven't exactly stayed the same, have they? They've kind of been on a journey.
Oh, definitely. Quite a journey is putting mildly.
Yeah.
Some really significant shifts, almost like watching a pendulum swing back and forth in legislation over just the last few years.
Okay, so let's walk through that timeline. Where did things start, say, before all the recent changes? Like for NOLs from tax years ending on or before December 31st, 2017.
Okay, yeah, back then, pre-2018 rules, if your business had an NOL in, say, 2017, you had this amazing flexibility, you could carry that loss forward indefinitely.
Indefinitely. So forever,
Pretty
basically.
much, yeah,
Yeah.
until it was fully used up.
Yeah.
You could just bank that loss and keep applying it against future taxable income year after year. And really importantly, it could offset 100% of that future income.
100%. So wipe the slate clean tax-wise for that year if the NOL was big enough.
Exactly. No residual tax bill once that NOL was applied.
Okay, that sounds pretty straightforward, pretty powerful. Then what happened?
Then came this really pivotal shift. It was specifically designed to provide pretty substantial relief, especially when the economy was looking shaky.
Right.
So for NOLs that came up in tax years starting after December 31st, 2017, but before January 1, 2021, so
Oh, yeah.
a very specific window, 2018, 2019, 2020.
Okay, that specific time frame, what was special about those?
Those NOLs got this, frankly, unprecedented power.
Hmm.
They could actually be carried back 5 years.
5 years back, so not just forward.
Right. Instead of just waiting to use the loss against future profits, companies could actively go back and claim a refund for taxes they'd already paid in prior profitable years.
Wow. Okay, I can see how that would be huge.
It was monumental. Think about the immediate cash flow relief that offered businesses struggling during that exact period,
Yeah.
especially, leading into 2020.
Yeah, absolutely. It wasn't just a tax benefit on paper, it was actual cash coming back in.
Precisely. For many, it was a lifeline, turning that paper loss into immediate liquidity. And just like the pre-2018 rules, these specific NOLs could also still offset 100% of taxable income in those years 2018, 2019, 2020.
So that temporary carryback was incredibly potent, like you said, a lifeline. It really shows how the tax code can be used as like an economic lever.
An economic shock absorber, yeah.
Yeah.
It showed the government was willing to use it quite directly.
But it sounds like that didn't last. That 5-year carryback party ended.
It did. Just as quickly as the rules swung one way, they swung back again, and pretty dramatically. So for NOLs arising in 2021 and onwards, we entered what we can basically call the new normal.
Okay, the new normal, what does that look like?
The biggest shift. Profound, really. These new NOLs from 2021 forward, they cannot be carried back at all.
Gone. That whole refund mechanism from past years just vanished for new losses?
Vanished. Now, you can still carry them forward indefinitely. That's still a significant benefit. Ensures the loss isn't wasted over time.
Okay, indefinite carry forward is still good. But there's a catch, I'm guessing.
There's a big catch, and this is potentially a sting for a lot of businesses. Starting in 2021, these post-2017 NOL carryforwards can only offset 80% of your future taxable income.
Only 80%, not 100.
Only 80%. And that's 80% after you've already deducted any of those older pre-2018 NOLs you might still have hanging around.
Huh. So even if I have a massive NOL carry forward, bigger than my current year's income, I still might owe tax.
That's exactly right. This 80% limitation is arguably one of the most critical things to understand for long-term tax planning now.
Wow.
It means, like you said, even with a huge NOL, you will still always have some tax liability because 20% of your future taxable income, it remains subject to tax no matter how big that NOL is.
It's like there's the floor now. You can reduce your bill, but never eliminate it completely with these newer NOLs.
Precisely. Like having a discount coupon that only works on 80% of your purchase. That last 20%, always full price. It fundamentally changes how companies need to plan for profits and manage those losses.
That really does change the long-term calculation. I'm thinking about, say, high-growth tech companies. They often swing between big profits and big losses. How does this kind of tax floor affect their decisions about maybe when to invest heavily or accelerate deductions or even time their income recognition?
That's a great question. It demands a much more nuanced approach. You can't just assume a future loss will wipe out a future profit entirely. You have to factor in that residual 20% tax liability. It affects forecasting. It affects the valuation of those losses. It affects decisions about timing. It's definitely more complex.
Yeah, it sounds like it. No longer just about wiping out the bill, but minimizing it within these new lines. Okay. So beyond those big picture changes, carrybacks, carry forwards, the 80% limit, are there other maybe more subtle things to know when you're actually calculating the amount of a corporate NOL?
Oh, absolutely. There are some very specific adjustments you need to make to your sort of book loss to get to the actual tax NOL figure. They might seem small, but they can definitely change the final number you get to use.
Okay, like what?
Well, for instance, any deduction you took for charitable contributions, that's not allowed when you're calculating the NOL itself.
Why is that?
It seems to stem from tax policy, wanting the NOL to reflect a loss purely from, operating the business, the core activities, not necessarily from deductions related to philanthropy or other non-operating things. It keeps the focus on the business's fundamental financial health, or lack thereof.
Okay, it keeps it focused on the operating part of net operating loss. Makes sense. What else?
Here's a really important one, especially for corporations that receive dividends. The dividends received deduction, or DRD.
Ah, yes, the DRD.
Normally, there's a limit on the DRD based on your taxable income. You usually can't deduct more than a certain percentage of your taxable income via the DRD.
Right, there's usually a cap.
But, and this is a big but, if taking the full DRD would actually create an NOL for you in that year, or make an existing NOL bigger, then that normal taxable income limitation, it just doesn't apply.
Whoa, okay. So if the DRD itself pushes you into the red, you get to take the whole thing, no limit.
Exactly. It's a very specific, but potentially very powerful rule. especially if you're receiving significant dividends and maybe hovering near break-even or small loss. It basically says, if this deduction is strong enough to cause the NOL, go ahead, take it all.
That's a nuance worth knowing. Anything else in these calculations?
Yeah, another point, really to prevent things from getting circular. You can't include an NOL deduction you carried over from a previous year when you're figuring out your current year's NOL.
Okay, so each year's NOL calculation stands on its own feet based on that year's activity.
Precisely. It prevents you from kind of, double dipping or creating a feedback loop with old losses. It keeps the focus on the new loss generated in the current period. They interact later when you use the NOLs, but not when you calculate the current one.
Got it. And you mentioned capital losses earlier. How do they interact when calculating an NOL? It sounded a bit tricky.
It is a bit nuanced, yeah.
Yeah.
So here's the distinction. A corporation can deduct a capital loss carryover. So a loss from a prior year against a capital gain it has in the current year, and that reduction can help create or increase the current year's NOL.
Okay, using old capital losses against current capital gains can help the current NOL.
Right. But here's the flip side. You cannot deduct a capital loss carryback. So taking a current capital loss back to a prior year against a net capital gain in determining the current year's NOL.
Okay, that is subtle. So bringing old capital losses forward is okay within the NOL calculation, but sending current capital losses back doesn't factor into this year's NOL calculation itself.
That's the essence of it. You can still do the carryback separately for capital loss purposes, but it doesn't directly influence the math for the current year's operating loss in the same way using a carryover does. It's about how these things intersect during the NOL computation for the current period. A fine point, but important for getting the number right.
Definitely sounds like it. The level of detail here really shows why good tax advice is so crucial. It's not just about filling in boxes. Okay, let's try and make this more concrete. Can we walk through an example, maybe see how these rules play out with actual numbers?
Absolutely. Examples are the best way to see the real impact. Let's take Johnson Corp. They're a calendar year C corporation, started up back in 2017.
Okay.
In 2020, Johnson Corp hit a rough patch and generated an NOL of $40,000.
$40,000 NOL in 2020.
Yeah. Now, for context, let's say their taxable income was pretty steady otherwise. From 2017 all the way through 2023, they made exactly $10,000 in taxable income each year.
Okay. Consistent $10K profit usually, but a $4K loss in 2020. And tax rates.
Let's say their marginal rate was 34% back in 2017, but then dropped to 21% from 2018 onwards, thanks to the Tax Cuts and Jobs Act.
Okay, perfect. This sets us up nicely to see the carryback, the carry forward, the rate changes, and that 80% limit in action.
So Johnson Corp has this $40,000 NOL from 2020. What happens first?
Right. First, we look at the carryback. Remember that 2020 NOL falls right into that special window we talk about, the 2018-2020 timeframe.
Ah, so it can be carried back to 5 years.
Exactly. And the rule is you carry it back to the oldest year first within that 5-year window. So 5 years back from 2020 takes us to 2015, but they only started in 2017. So the oldest applicable year is 2017.
Okay, so start with 2017. They made $10,000 that year.
Right. So they take $10,000 of their $40,000 NOL and carry it back to 2017, completely wiping out that year's taxable income.
And the benefit?
The benefit is a refund. Since the tax rate in 2017 was 34%, wiping out $10,000 of income gets them a refund of $3,400. That's actual cash back from the IRS.
Nice. Okay, so $3,400 back. They still have $30,000 of their NOL left. 40K, 10K. What next? Next oldest year is 2018. They also made $10,000 in taxable income that year. So they use another $10,000 of the NOL to wipe out 2018's income.
And the tax rate was different then, right? 21%.
Correct. 21% rate in 2018. So carrying back $10,000 gets them another refund, this time for $2,100.
Okay, another $2,100 back. Now they've used $20,000 of the NOL, 10K plus 10K, and have $20,000 left. On to 2019.
On to 2019, same story. $10,000 taxable income. They use another $10,000 of the NOL. The rate was also 21% in 2019.
So another $2,100 refund.
Exactly. So let's tally that up. Through the carryback, Johnson Corp got refunds totaling $3,400 plus $2,100 plus $2,100. That's $7,600 back in their pocket.
Wow, that's a really tangible benefit from having that loss in 2020, almost $8,000 in refunds. Okay, so they carried back $30,000 in total, 10K by 3 years. They started with $40,000. That leaves $10,000 of the NOL still unused.
Precisely. That remaining $10,000 can't be carried back any further, so it gets carried forward to the next available year, which is 2021.
Okay, forward to 2021, and Johnson Corp made $10,000 in taxable income in 2021. Can they just use the full remaining $10,000 NOL to wipe it out?
Ah, But now we hit that new normal rule, the 80% limitation. Since this NOL is being used in 2021, a post-2020 year, even though it originated in 2020, its use is limited.
Right. The 80% rule applies to the year it's used, if it's 2021 or later.
Correct. So in 2021, Johnson Controls has $10,000 of taxable income. The maximum NOL deduction they can take is 80% of that income. 80% of $10,000 is $8,000.
So they can only use $8,000 of their remaining $10,000 NOL in 2021.
That's right. They used $8,000, reducing their 2021 taxable income down to $2,000. They still owe tax on that $2,000, and they still have $2,000 of the NOL left over. $10,000, $8,000 used.
Okay, so that $2,000 NOL gets carried forward again, this time to 2022.
Yes. Now, in 2022, Johnson Controls again had $10,000 in taxable income. The 80% limitation still applies, meaning they could deduct up to $8,000 in NOL if they had it.
But they only have $2,000 left.
Exactly. Since the remaining $2,000 NOL is less than the $8,000 maximum they're allowed to deduct, 80% of $10, they can use the entire remaining $2,000.
Ah, okay, so the limit is a ceiling, not a requirement to only use 80%. If you have less than the ceiling allows, you use it all.
You got it. So they use the final $2,000 in 2022. Their 2022 taxable income is reduced to $8,000, 10K, 12K. And now the $40,000 NOL from 2020 is completely used up. Zero carry forward to 2023.
Wow, that example really walks through everything. You see the cash refund from the carryback, the rate changes, and crucially that 80% limitation biting in 2021, leaving a bit of tax liability and stretching out the use of the NOL into 2022.
It perfectly illustrates the mechanics, the cash flow benefits of carrybacks when allowed, and yeah, the very real impact of that 80% ceiling for newer NOLs used today. For you listening, it really highlights how one loss year can ripple effect across multiple tax years, impacting the bottom line and cash flow significantly.
Yeah, it's definitely not just about the year the loss happens. It's a multi-year strategy game.
Now let's pivot a little bit. We've talked about generating and using NOLs, but there's another critical piece, especially when companies change hands. Limitations that can suddenly clamp down on the ability to use those valuable NOLs. We're talking about Internal Revenue Code Section 382.
Section 382. Okay, this sounds like a potential roadblock. You mentioned earlier the tax code tries to balance legitimate planning with stopping abuse. Is this related to that?
Exactly related. Congress put Section 382 in place specifically to prevent something called tax loss trafficking.
Tax loss trafficking. Sounds illicit.
It basically refers to the scenario where a profitable company goes out and buys another company, a loss corporation, primarily just to get its hands on that company's large NOL carry forwards.
Ah, so buying losses just to shield their own profits without a real business reason for the merger.
Precisely. The idea behind Section 382 is to ensure the tax system's integrity, to make sure mergers happen for genuine business synergy, not just as a tax avoidance scheme. It tries to stop people from just buying and selling tax attributes detached from the underlying business.
That makes sense. Otherwise, you could just have companies with huge historical losses constantly being bought and sold purely for the tax break, right?
Right. It would undermine the whole system. So Section 382 acts as a deterrent, a very specific one.
How does it work then? What triggers these limitations?
The trigger is a specific event called an ownership change. When an ownership change happens at a loss corporation, the Section 382 limitations kick in.
Okay, so we need to define ownership change. What constitutes that?
It's defined pretty precisely. An ownership change occurs if one or more 5% shareholders, we'll define that in a second, collectively increase their ownership stake in the loss corporation stock by more than 50 percentage points compared to their lowest ownership level during a specific testing period.
Okay, that sounds technical. More than 50 percentage points, 5% shareholders. Testing period. Let's break that down.
Let's do it. A 5% shareholder is pretty much what it sounds like. Anyone who owns, directly or indirectly, 5% or more of the loss corporation stock at any time during the testing period. It can also include groups of smaller shareholders who might act together.
Okay, 5% or more owners. And the testing period.
The testing period is generally the 3-year period ending on the date that the potential ownership change occurs.
Yeah.
So you're looking back over the prior 3 years.
Right, looking back 3 years to see if the ownership structure shifted significantly among those key 5% plus shareholders by more than 50 percentage points in total.
Exactly. And it's not just about direct stock purchases. Mergers, reorganizations, even certain stock options being issued or exercised can trigger this if they cross that 50 percentage point threshold. It's designed to catch various ways control can shift.
Okay, that wide net makes sense if you're trying to prevent clever workarounds. Let's use an example again. Say ABC Corp is our loss corporation sitting on some NOLs.
Okay, ABC Corp.
On January 1st of year 4, 3 people, X, Y, and Z, each buy 20% of ABC Corp's stock.
Okay, XYZ each acquired 20%.
Now, here's a wrinkle. X actually already owned 5% of ABC Corp stock, which they bought back on January 1st of year 2, but Y and Z owned nothing before this big purchase in year 4.
Got it. X had 5% previously, Y and Z were new.
So the big question for ABC Corp, did this transaction trigger a Section 382 ownership change? Will their NOLs be limited now?
Let's run the numbers based on that definition. First, identify the 5% shareholders involved in the potential change. Here, that's clearly X, Y, and Z, as they all end up owning 20% or more.
Right. X has 25% total now, 5% old plus 20% new. Y has 20%, Z has 20%, all over 5%.
Now, we calculate the increase for each, comparing their current ownership to their lowest ownership percentage during the 3-year testing period, which goes back to Jan 1, year 1.
Okay. For X, current is 25%. Lowest during the past 3 years was that 5% they bought in year 2. So their increase is 25% minus 5%. That's a 20 percentage point increase for X.
Correct. For Y, current is 20%, lowest was 0%. So their increase is 20 percentage points.
Same for Z, right. Current 20%, lowest 0%. So another 20 percentage point increase.
Exactly. Now, we add up those individual increases. 20 points from X plus 20 points from Y plus 20 points from Z equals
60 percentage points total increase among these 5% shareholders.
And since 60 percentage points is definitely more than 50 percentage points.
Bingo. An ownership change has occurred. Section 382 limitations applied to ABC Corp's NOLs.
That's right. And just to reiterate that point from the source material, you always compare to the lowest ownership point in that 3-year window.
Yeah.
That prevents someone from, say, buying 4% years ago, then buying 48% now and claiming it's only a 48-point increase. You measure from the bottom.
Good point. Captures the full magnitude of the shift. Okay, so an ownership change happened. Does that mean the NOLs are just gone, wiped out?
No, not completely gone, which is important. It's not usually an outright elimination. Instead, Section 382 imposes an annual limit on how much of the pre-change NOLs can be deducted each year going forward.
Okay, an annual cap. How is that cap calculated? Is there a formula?
There is a formula, and it directly ties the limitation to the value of the company at the time of the change. The annual Section 382 limitation amount equals the fair market value, FMV, of the loss corporation stock immediately before the ownership change.
Okay, the company's value right before the trigger.
Multiplied by the federal long-term tax-exempt rate.
The long-term tax-exempt rate, why that specific rate?
It's published by the IRS and reflects current interest rates on things like long-term government bonds. Conceptually, the idea is that the limitation should roughly equal the income the acquiring company could have hypothetically earned if they just took the money equal to the value of the lost company's stock and invested it passively in safe, tax-exempt bonds.
Huh. So it's like saying you can only use the NOLs to offset an amount roughly equal to the passive income this acquired value could have generated anyway?
That's a pretty good way to think about the underlying theory, yeah. It limits the NOL usage to a sort of baseline return on the acquired company's value.
Interesting. What if the company doesn't have enough income in 1 year to use up the full annual limit? Is that portion lost?
Good question. No, thankfully it's not lost. Any unused limitation amount from 1 year gets carried forward and increases the limitation amount for the next year. That provides some needed flexibility.
Okay, that carry forward of the limit itself is helpful. Let's apply this calculation to ABC Corp. Remind me of their situation.
Right, ABC Corp. Ownership change happened Jan 1, year 4. Let's say they had $1 million in NOL carryforwards at that time.
Okay, $1 million in NOL is potentially limited.
And let's say the fair market value of ABC Corp's stock right before the change was $3 million.
Value $3 million. And the rate?
Let's use 2% as the relevant federal long-term tax-exempt rate for that period.
Okay, so the annual Section 382 limitation is $3 million FMV times 2%. Rate, carry the zero, that's $60,000.
Exactly. $60,000 per year is their Section 382 limitation.
So wait, they have $1 million in NOLs, but they can only use $60,000 of it each year against their future income.
That's the impact. It dramatically reduces the speed at which they can benefit from those pre-change NOLs. What might have looked like a huge immediate tax shield becomes a much smaller, slower trickle.
That absolutely changes the economics of acquiring a company for its losses, doesn't it? That $1 million NOL is suddenly worth a lot less in present value terms.
Precisely. It forces potential acquirers to have a much stronger business reason for the deal, beyond just the tax attributes. The tax benefit is significantly curtailed and spread out over potentially many, many years.
Okay, let's shift gears again. We've talked a lot about net operating losses. Now let's focus specifically on capital losses for corporations. You hinted earlier they play by different rules.
They really do. And this is a key area where corporate tax rules diverge significantly from individual tax rules, which can catch people out.
How so? What's the main difference?
Well, think about individuals. If you have net capital losses for the year, you can usually deduct up to $3,000 of that loss against your ordinary income, right?
Right.
Like salary or business income.
Right, that $3,000 deduction is pretty common knowledge for investors.
Okay, well, for corporations, forget about it. That $3,000 net capital loss deduction against ordinary income, it is absolutely not allowed.
Not allowed at all. Wow, okay, that's a huge difference right there. So corporate capital losses are treated much more strictly.
Much more strictly. It means if a corporation sells stock or other capital assets at a loss, that loss generally can't be used to directly reduce the tax they owe on their main business operations income.
So if they can't use them against ordinary income, how can corporations use capital losses? Are they just useless if they don't have capital gains in the same year?
Not useless, but definitely restricted. Corporations can only use capital losses to offset capital gains, period.
Only gains against gains, a very specific lock and key, like you said earlier.
Exactly. If a corporation have a net capital loss in year one and no capital gains in year one, that loss provides zero immediate tax benefit against their operating income. It just sits there.
Okay, but it doesn't vanish. Can it be carried over?
Yes, it can be carried over, but the rules are different from NOLs too.
Yeah.
Corporate net capital losses have a much shorter lifespan. They can be carried back 3 years
3 years back.
and carried forward only 5 years.
Only 5 years forward. That's way shorter than the indefinite carry forward for NOLs.
Much shorter.
Yeah.
That 5-year clock is ticking. If you don't generate enough capital gains within that carry back and carry forward period to absorb the loss, it expires worthless.
Wow. Use it or lose it within a pretty tight window. Any other quirks with the carryover?
One more important detail. When these capital losses are carried back or forward, they're always treated as short-term capital losses, regardless of whether they started as long-term or short-term losses.
Always short-term on carryover. Okay. And just to hammer it home, they can only be used against capital gains in those other years?
Only against capital gains. This whole structure really incentivizes corporations to manage their capital asset sales carefully. You might, for example, intentionally sell an appreciated asset to generate a capital gain, specifically to utilize expiring capital loss carryforwards that would otherwise vanish.
Right. You need to actively manage both sides of the capital gain loss equation. Okay, let's try another example. How do these capital loss rules work in practice, maybe even interacting with an NOL calculation?
Good idea. Let's take Lane Corp.
Wayne Corp, okay.
Lane Corp has $400,000 in gross income for the year. Importantly, that $400,000 includes a $150,000 capital gain.
Okay, $400K gross with $150K of that being capital gain.
On the expense side, they have $500,000 in operating expenses.
$500 operating expenses. So just looking at operations, they're already in the red.
Seems that way. And one more piece. Lane Corp also has a $20,000 unexpired capital loss carryover from a prior year.
Okay, $20K old capital loss available. So how do we figure out Lane Corp's tax situation for the year, particularly their NOL?
Okay, let's walk through it. First, deal with the capital items. They have a $150,000 capital gain this year and a $20,000 capital loss carryover.
Can they use the carryover against the gain?
Yes, absolutely. Capital loss carryovers can offset current year capital gains. So they use the full $20,000 carryover, which reduces their net capital gain for the year down to $130,000. 150K, 20K.
Okay, net capital gain is 130K. What does that do to their overall income picture for NOL calculation?
Well, remember their total gross income was $400,000. Since $20,000 of the capital gain component was effectively neutralized by the loss carryover, their adjusted gross income for the NOL calculation effectively drops. Think of it as $250K operating income plus $130K net capital gain, or simply $400K original gross 20K loss utilized. Either way, you get to $380,000.
Okay, so the income base for the NOL calc is $380,000.
Right. Now subtract their operating expenses of $500,000 from that $380,000 adjusted gross income.
$380,000 minus $500,000. That gives us a negative $120,000.
Exactly. Lane Core has a net operating loss of $120,000 for the current year.
Okay, here's what's jumping out at me. That $20,000 capital loss carryover, even though it could only be used against the capital gain. By reducing that capital gain, it actually made the operating loss bigger, didn't it? If they hadn't used the capital loss carryover, the income would have been $400K minus $500 expenses for only $100K NOL. But using the capital loss carryover bumped the NOL up to $120K.
You nailed it. That's the fascinating interaction. The capital loss carryover, while restricted to offsetting only capital gains, indirectly increased the current year's NOL.
That's a really crucial takeaway. Strategically using capital loss carryovers against capital gains can actually enhance the value of your operating losses.
Absolutely. It shows how interconnected these things are. You can't just look at operating income and expenses in a vacuum. How you manage your capital gains and losses feeds directly into the overall NOL calculation. The holistic picture.
Holistic, yeah. More complex than the sum of its parts, like you said. Okay, we've explored NOLs, we've explored capital losses, we've seen the Section 382 limits. Now let's try to tie it all together with a more comprehensive example, something that shows how all these different rules bump up against each other in a real-world kind of scenario.
Good plan. Seeing them interact is key. It really reveals the complexity, but also the potential for really strategic tax management. It's one thing to know the rules in isolation, quite another to see them dance together.
Exactly. So let's invent a company, maybe call them Losco.
Losco, I like it.
Yeah.
Appropriate. Okay, let's look at Losco's financials for, say, 2023. They are a calendar year C Corp.
Okay, Losco, 2023, what's their situation?
Their growth income from regular operations was $250,000.
$250K operating income.
They also received $50,000 in dividends. And let's say this was from a company where they own 40% of the stock. That ownership percentage will be important later for the DRD.
Okay, 50K dividends from a 40% owned company. Got it.
And they had capital gains of $10,000 during the year.
$10K capital gains. So total income items, 250K plus 50K plus 10K equals $310,000.
Correct. $310,000 total income.
Right.
Now, on the deduction side, they had $280,000 in other deductions, things salaries, rent, supplies, etc. This $280K does not include any dividends received deduction yet. We calculate that separately.
Okay, $280K operating type deductions. And just to make it messy, like real life, did Losco start 2023 with any baggage, any carry forwards?
Oh, absolutely. Got to have carry forwards. Let's say for capital losses, they had $2,000 left over from way back in 2020 and another $10,000 carried forward from 2022.
So $12,000 total capital loss carry forward available at the start of 2023, 2K from 20, 10K from 22.
Right. And for net operating losses, they had some even older stuff.
Yeah.
$20,000 carried forward from 2004.
Wow, 2004. That's an old one.
Yep. Still kicking thanks to the old 20-year carry forward rules back then. And they also had $50,000 carried forward from 2019.
Okay, so $70,000 total NOL carry forward, 20K from 04, 50K from 19, ready to go at the start of 2023. This company has layers.
Layers indeed. Okay, so job number one. Calculate Losco's 2023 taxable income or loss before we even think about the dividends received deduction.
All right, start with the total income, $310,000.
Now look at the capital items. They have a $10,000 capital gain this year and $12,000 in capital loss carry forwards. 2K from 20, 10K from 22. Can they use the carry forwards?
Yes, they can use capital loss carry forwards against capital gains. They need to offset $10,000 of gain. Which carry forward do they use first? Does it matter?
Generally, you'd use the oldest first to avoid expiration, but here, since they need $10 and have $10 available from 2022 and only $2 from 2020, the source material example seems to use the $10,000 from 2022 to fully offset the current $10,000 gain.
Okay, so use the $10 from 2022. That wipes out the current capital gain completely. Net capital gain for the year is zero.
Right. So going back to our income calculation, $310,000 total income minus the $10,000 capital loss carry forward used to offset the gain gets us down to $300,000.
Okay, $300,000 effective income after dealing with capital items. Now subtract the other deductions.
Now subtract the other deductions of $280,000.
$300,000 minus $280,000 leaves $20,000.
Exactly. Losco has $20,000 of taxable income before considering the DRD.
Okay, step one done. Now, the dividends received deduction. They got $50,000 in dividends from a 40% owned company. What's the DRD percentage for that?
For ownership between 20% and 80%, the DRD percentage is generally 65%.
Okay, 65%. So the tentative DRD, before any limits, is 65% of the $50,000 dividends received. Let's see. 0.65 times 50,000 is $32,500.
Correct. Tentative DRD is $32,500. Now remember the potential taxable income limitation.
Right. Normally, the DRD might be limited to 65% of taxable income before the DRD. Taxable income before DRD was $20,000, so 65% of $20,000 is $13,000. So is the DRD capped at $13,000?
But here comes that crucial exception we talked about. Is the DRD limited to $13,000 in this specific case?
Okay.
Let's check. If they took the full tentative DRD of $32,500, would it create an NOL?
Well, they had $20,000 of income before the DRD. If they subtract the full $32,500, yes, $20,000, $32,500, negative $12,500. It creates an NOL.
Bingo. And because taking the full tentative DRD creates an NOL, the normal taxable income limitation, $13,000 in this case, does not apply. They get to take the entire $32,500 deduction.
Fantastic. That rule is a lifesaver here for Losco. It turns what would have been taxable income into a loss.
It's a huge swing factor. So now we can definitively calculate Losco's 2023 net operating loss. Start with the $20,000 taxable income before DRD,
And subtract the full unlimited DRD of $32,500.
which results in a $12,500 net operating loss for 2023.
There it is, a $12,500 NOL generated this year. And just to be clear, we didn't use any of those carry forwards from 2004-2019 when calculating this year's loss, right?
Correct. Prior year NOL carryforwards are not factored into the calculation of the current year's NOL. This $12,500 is purely a result of 2023's numbers and rules.
Okay. So Losco now has a new NOL asset. How does all this activity update their carry forward schedules? Let's start with the capital losses.
Okay, capital losses. They started with $2 from 2020 and $10 from 2022. They used $10 this year against the capital gain. According to the source materials updated table, it seems the $10 K used came from the 2022 carry forward.
So the $10 K from 2022 is fully used now.
Actually, the source's updated schedule seems to show something slightly different in the end result. It shows the $8 K originally generated in 2020 as fully utilized, and $8 Ks utilized from the $10 generated in 2022. This leaves $2,000 from 2022 still available as a carry forward. It also notes $2,000 expired in total, but doesn't specify which year. Let's stick to that final outcome presented in the source.
Okay, so final capital loss picture. $2 K from 2022 carries forward. The $2 K from 2020 was used up somewhere along the line, perhaps against prior gains not detailed here, and $8 K from 2022 was also used. $2 K expired from somewhere. It's complex tracking.
It really is. Keeping these schedules updated accurately year to year is vital. Now, for the net operating loss schedule.
Right. They started with $20K from 2004 and $50K from 2019, and they just generated $12,500 in 2023.
So the updated NOL schedule looks like this. $20,000 carry forward from 2004, still untouched. $50,000 carry forward from 2019, also untouched. And now a new line item, $12,500 carry forward generated in 2023.
Add those up. $20K plus $50K plus $12.5K equals $82,500. That's their total NOL carry forward balance going into 2024.
A nice tax shield accumulating there.
Okay, so looking ahead, let's say Losco finally turns things around in 2024 and actually has taxable income. How do they start using this $82,500 NOL balance? What's the pecking order?
Great question. The absolute rule is oldest NOLs first.
Oldest first. So that $20,000 from 2004 gets used before anything else.
Correct. And importantly, remember that 2004 NOL has an expiration date looming. Under the old rules, it was likely a 20-year carry forward. So 2004 plus 20 years means it expires after 2024. They must use it in 2024 if they have income, or it vanishes.
Good point about expiration for those really old ones. And how much income can that 2004 NOL offset? Is it subject to the 80% limit?
No, that's the beauty of the old NOLs. Because it was generated before 2018, the 2004 NOL can offset 100% of 2024 taxable income up to the $20,000 amount of the NOL.
Ah, grandfathered under the old rules. 100% offset for the 2004 portion. Okay, so let's say they use all $20K from 2004 and 2024. What's next?
Next in line would be the $50,000 NOL from 2019.
And that one is subject to the 80% limit, right? Because it's
Yeah.
post-2017.
Correct. The 2019 NOL and the 2023 NOL after that can be carried forward indefinitely, which is good. But when used against income in 2021 or later, like our hypothetical 2024, they can only offset 80% of the taxable income that remains after applying any pre-2018 NOLs, like the 2004 ones.
So in 2024, they'd first use the 2004 NOL at 100%. Then, whatever taxable income is left, they can use the 2019 NOL against 80% of that remaining income. Then, if there's still income left and they need more NOL, they dip into the 2023 NOL, also subject to the 80% limit.
You've got the sequence and the limitations exactly right. It's a tiered approach applying different rules based on when the NOL was generated.
This loss come example is fantastic because it really pulls everything together. You see the DRD calculation creating an NOL, the capital loss carryovers getting utilized, the updating of the schedules, and most importantly, that future application waterfall oldest first with different percentage limitations. It really drives home that tax planning isn't just about this year, it's a long game.
It absolutely is. Understanding these interactions, the chronological application, the percentage limits, that's where the real strategic management comes in.
So we've really covered a lot of ground here. We've journeyed through this pretty sophisticated world of net operating losses and corporate capital loss limitations. Hopefully, we've managed to turn some of that dense tax code into more actionable strategic insights for you.
Yeah, the goal was to give you a better handle on how these tools work.
Right. You should now have a deeper understanding of how these powerful mechanisms, the NOL carrybacks and carry forwards and how they've changed, the very specific Section 382 limitations designed to stop trafficking, and those unique, much stricter rules for corporate capital losses, how all of these can really impact a business's tax situation.
Providing opportunities for refunds, cutting future tax bills, and enabling smarter financial planning overall.
Exactly. Knowing these rules, it isn't just about checking boxes for compliance. It really is about empowerment, about finding ways to gain a strategic edge.
And that leads to maybe a final thought, a question to ponder. This whole deep dive, it really highlights that even in something as seemingly rigid as tax law, there are these critical nuances, these levers you can pull. So the question becomes, if you went back and did a really thorough review of your own company's historical financial data, looking specifically for maybe unrecognized losses or carryovers that weren't optimized, could you uncover hidden opportunities? Might there be significant tax savings sitting there, just waiting to be found that you might be overlooking right now?
That's a great provocative thought. Are there dormant tax assets in your own history? The real value, as always, is putting this knowledge into practice.
Absolutely.
We really hope this deep dive gives you the confidence to ask more informed questions, maybe of your tax advisors, maybe just of your own assumptions, and perhaps even uncover some of those unexpected financial advantages for your business. Until next time, keep digging, keep learning, and keep thriving.